Hey, Jackson here, and I've gotten a lot of questions recently about interest rates and a lot of concern over interest rates and what does this mean? And so I thought this might be just a helpful, quick little video with a few talking points, a few resources that may help you and your clients understand how to better manage these situations. So just to give you a current state of the market as of February 7th, 2022, rates have gone up quite a bit in the last month, probably about 1%. So a couple of resources I typically direct people to is you could look at the 10-year treasury. We're trading at about 1.92. That's really easy to find on your Apple phone. You can pull that up, or you can just type in 10-year treasury and see what it's trading at. About a month ago, or a little bit, maybe last month or two, we've kind of gone from the low ones up to pretty close to two. So whenever that's going up, that usually signals rates going up. One of the other resources I find that's very helpful in terms of being able to get good data on what rates are at is bankrate.com mortgage analysis. So bankrate.com, typically more of an internet-based lender, so it's going to be a little bit more maybe on the cheaper side, but they do a publication every Thursday. They do a survey of all the large lenders in the country, and as of today, the 30-year or most recent study is 3.76. So that's a pretty big increase. And about a month ago, we were probably in the high two. So about a 1% increase in interest rates in a single month. Okay. If we go to Quicken Home Loans, they're the largest lender in the country. As of today, they're quoting a rate at 3.99 on a 30-year fixed rate mortgage, assuming good credit and 25% down. Okay. Wells Fargo, one of the larger lenders out there, they're quoting around 3.875. And then we know probably in March, the Fed's going to continue to raise rates. So that what they charge in terms of their short-term loans has an impact on long-term rates with a 30-year fix. So them raising that potentially will, have an impact of higher rates on our side as well. So really what I do is today's video, I just want to let you know, I've got three different resources. Number one, I've got a rent versus own tool. So your clients who are renting, who are a little bit scared, we want to be able to show them, hey, smoking is not good for your health. Renting is not good for your wealth. If it rhymes, it's true. And so there's a cool little tool I have that shows you the cost of renting versus owning to help your renters. Then we have a cost of waiting tool, meaning that like if we've got a client that's like, well, I'm going to wait for the housing market to calm down. I'm going to wait another 6 months a year. We can show them the cost of waiting 1 year or 6 months. We also have a third tool, which is called a smooth start program. So for those clients that are like super freaked out about the fact their rates way higher and just cannot take it, we have a way to basically give them a lower interest rate for the first year. So let's say we lock them in today at 3.875. That means we could give them a rate at 2.875 for the first 12 months. It's kind of a unique program, and it helps. We call it our smooth start program. It basically says, hey, your 30-year fixed rate mortgage really is 3.875, or at least as of today, right around there. There's always ways to buy down the rate. Internet lenders do that. Other lenders do that. But in terms of standard rates and fees, the market's trading at about 3.875. So those are three different tools that I can offer you. So just to give you a quick little overview, one of them, and then you can always just reach out to me if you have more questions, is take a look here, right? So if we're at a 3.5% interest rate on a $375,000 purchase price, okay, so putting 10% down the loan amounts here. So your payment here is $23.41, okay? So really what I want you to be able to see is for every 0.25% in interest rate, that payment goes up about $47. Okay, so not the end of the world, but let's say we go from 3.5 to 4.25, okay, which is probably where we're headed in the next month or so. That is a difference of $144 a month. Okay, so we want to use that, capitalize that on an opportunity to tell people like now is the time to go ahead and get under contract because home prices and interest rates are going up. Let's ride that wave up rather than getting hit by it in 6 months or so. So the other thing on the rent versus own analysis in this case, if someone's renting for $2,000, this tool allows them to see renting for 5 years at $2,000 a month, approximately $140,000 down the drain. No return on that money. Doesn't seem like that much when you say it monthly, 2,000, but when you put it over a 5-year period of time, it just seems like a lot and has more of an impact when you're talking to a client. Versus you'd get 34,000 in principal paid down, and then you would also take that 375 home to 456 in appreciation, assuming 4%. So instead of throwing $140,000 down the drain, you're going to have $153,000 in equity in your home in 5 years. So it's just, these are different tools I wanted you to be aware of. I hope this is helpful, and I hope to hear from you. 214-586-0517 is my office line. My cell is 214-763-8008. Have an amazing day.